And a couple comments with the sound quality. If you guys would go ahead and just put the mic on when you take the podium, I think that would be helpful. And also, we're running about 8 minutes behind. But this afternoon, Delegate Benjamin Klein is not going to be able to join us, so we'll kind of make up that time then. And perhaps we'll move into lunch about 8 minutes late, come back from lunch 8 minutes late, and then still get out on time this afternoon. So just wanted to make that announcement. Mr. Miller.
Okay. Good morning. I enjoyed hearing about The Wire yesterday. It is unquestionably the best television show of all time. However, I think the true tragic character of the show is misidentified. To me, everybody knows this show, so I can speak about it freely. The true tragic character is Stringer Bell. Stringer Bell is a gangster and a drug dealer. But he is a smart gangster and drug dealer who educates himself by studying economics. And after he does this, he studies the economics of the heroin market in Baltimore, or Balmer, as we say in Maryland. And he identifies the sources of deadweight loss in the market. He identifies the frictions that cause unneeded expense in this market. He organizes his competitors in a way that is designed to maximize their cartel market power. He eliminates joint costs in this market, and his reward for all of this is that he gets whacked in season 4. So today I also have to tell you that in addition to celebrating this amazing TV show, we celebrate the greatest movie of all time, which is This is Spinal Tap. Today, as you know, is Nigel Tufnell Day. If you are not familiar with the movie, you just need to see it because it's all about 11. My name is Hilary Miller. I'm a statistician by training and a lawyer by profession. This is a somewhat dangerous combination of credentials, although having worked both sides of the street, I can tell you that the lawyers have better parties, and we also have women who attend them. In my current job, we support and promote principled research designed to assist people in thinking about how to regulate payday loans. I've been working with payday lenders since 1994, and although I have a great deal of experience in this market, I am not here to advocate on behalf of payday lending. What I'm here to do is merely to ask you to change your religion. We'll come back to that in a minute. So you'd think with 17 years of experience, I knew a thing or two about payday loans. But I'm here today to confess to you my complete ignorance about the most important public policy issues regarding how the use of payday loans affects consumers. What we don't know is at once surprising and extremely disconcerting. And in years of setting public policy for this industry, our governments have relied primarily on anecdotes, prejudice, religious pressure, and the balancing of campaign contributions from competing groups, rather than on evidence. What kind of evidence, you might ask? Well, in over a decade of research regarding payday lending, we've still not answered the fundamental question of whether payday loans relieve or exacerbate financial distress for consumers. In this regard, I commend to you a very good and for lawyers mercifully brief paper by John Caskey, once again, in which he collects the known research regarding the consumer welfare implications of payday lending and explains why what we know is not adequate to answer what he calls the big question. So to find this article, just Google Caskey Big Question. You can't miss it, and it's required reading. The papers collected by John show, at best, a mixed picture regarding the consumer welfare impacts of payday loans, with some of the studies showing that payday loans are slightly helpful, and others showing that they are slightly harmful to consumers. The key word here is slightly. None of them shows a large effect either way, either helpful or harmful. There have been a few additional papers published since John's collection, which I can email you citations to if you want. They serve principally to add additional murk to this picture. So there's another problem with the large body of existing and ambiguous research regarding payday lending. It looks primarily at the mean effects of payday lending. In other words, it looks at the aggregate effects of payday lending on large populations, and it tells us almost nothing about the distribution of those effects within the population. In other words, it doesn't tell us who within the population is likely to be helped or harmed by payday loans. And those are things that I, as a regulator, would want to know before deciding how to regulate that market. Here's some other things we don't know. While rollovers are frequently cited as an anecdotal source for problems of borrowers, there's no research, and I mean none, showing that consumers who are prevented from rolling over their loans are better off than consumers who are allowed an unlimited number of rollovers. Indeed, we have no evidence to support what the right number of rollovers is, whether it's any number greater than 0. And we have no reason to suspect that whatever the right number is the same number for all consumers, regardless of their individualized financial circumstances and sophistication. Some states, like this one, have implemented databases to enforce rollover limitations, yet no one has conducted even the most basic research to determine whether consumers in database states have better welfare outcomes than consumers in non-database states. And while many well-intentioned and thoughtful people have concluded that consumers frequently remain in payday debt for too long, there is no science to support the conclusion that this occurs because of a defect in the payday loan product, rather than simply because consumers need to have debt outstanding for longer time periods. When you don't have evidence, you persuade with loaded terms like debt trap and cycle of debt. These are not words of science. They are political epithets. I could go on, but I think it's now time for your religious conversion. I would like you to join me just for one day in my church, the Universal Church of Agnosticism. And I would like to ask yourself, as you hear the panels, this panel and those that will follow, whether the information that they're talking about was collected in a scientific manner that involves a large-scale, reliable data set under controlled circumstances with reliable reporters and reproducible results. I ask you to use your best critical thinking skills to decide whether the manner in which these data were collected ensures not only that horror stories and poster children will be memorialized, but also that the data represent a true sample of transactions and the population who uses these products. I ask you to think critically about anything that is presented to you using loaded and normative terms. Most importantly, if you, like me, are willing to admit what you don't know, and you believe that regulation should be evidence-based, perhaps the correct public policy tool for all of us is a scalpel rather than a broad axe. I'm proud to have a distinguished panel today. It includes some old friends and some new ones, like my drinking buddy on the left. Their bios are all in your materials, and I won't read them to you because I assume you've read them already. They're an amazing group. Today we will disagree without being disagreeable, and as the moderator, I will be moderate. See you in church.
Okay. Is somebody keeping time? Okay. All right. I was worried that you were going to be keeping time. I heard you get everybody quiet, and I got really concerned. If I went over time, boy, she's going to yell at me. But I really wasn't quite sure why I was asked to come to this before I came, and now I'm really not sure why I'm here at all. First of all, I do not watch that TV show. I've never seen it. I have no clue about that movie. And also, you basically undercut everything I'm going to say before I said it. But nonetheless, I'm supposed to give you 20 minutes, and I'm going to give you 20 minutes. I don't have a paper to present either, of course. I'm not an academic. Now, Mr. Webster also doesn't have a paper, and he's not an academic. But at least he's on the Board of Visitors, right? I mean, he has some connection. But what I was asked to talk about was the perspective on the legislative process. I was also asked to talk about the bargaining and trade-off aspects of getting regulations passed. Now, let me tell you what may qualify me to have some knowledge about this area. As I say, I've done no research and I have no paper. I have worked at our Virginia General Assembly since the year 2000 on payday and car title loan and other predatory lending issues. I have seen at least 50 bills, which is, for those of you that don't do legislative work, that is an enormous amount of bills on one subject. Some have been passed, and some I've worked to pass, and some I've worked to defeat. I have litigated cases over predatory lending for clients who have been caught up in these loans. I work with legal aid attorneys around the state who have many, many predatory lending cases. I regularly consult, collaborate, and commiserate with other consumer advocates on these issues, including not only in Virginia but all around the country. I speak regularly with and to community groups about predatory lending. And then finally, what may or may not qualify me more than anything is my office runs a hotline. Anybody in Virginia who has a problem with a payday or car title loan can call us toll-free, and many hundreds of people have called us. And I have talked to many, many of those people. And my colleague Dana Wiggins, who's sitting back here, has talked to many more of these folks. And through that hotline, which we have done, I think, for 2 or 3 years, I can't remember exactly.
Since 2009, or fall of 2008.
Since the fall of 2008. So we've been doing it a long time. And lots of people call us that have problems with payday and car title loans. And by the way, some people call us, they get the number and they want to know where they can get a payday or a car title loan. And so we're not very helpful with that, but we are very helpful on other issues. Let me tell you about 4 typical calls that we get on our hotline. I pick up the phone and a woman says, "I am so ashamed. I was so stupid. I needed money to get Christmas for my grandchildren. Someone had to buy them a present, so I went to one of those payday loan stores. How bad could it be?" I thought to myself. I mean, how bad it could be? It's on the government allows this. It can't be that bad. It's on every street corner. So I borrowed $500. And then I found out it's all due on my next payday. So what did I do? When I got paid 2 weeks later, I cashed my paycheck. I came in and I gave them $575 to pay off that $500 loan. I slid it across the table to the payday lender, and they said to me, "Ms. Jones, do you need another loan?" And I said, "Hell yes. That's almost my entire check. Now I can't pay my rent. Of course I need another loan." And so they took the $75 out and they slid that money back to me. Now I've been doing this for 8 months. Every 2 weeks I go to the payday loan store. I need to get out of this loan. Help me, I'm trapped. Caller number 2. "I'm scared to death. A man just called me saying," no, a woman, excuse me, just called me from the sheriff's department. She said, "I'm going to go to jail if I don't pay back the car title loan that I took out." Actually, I think it was a payday loan. I'm scared to death. I can't go to jail. I'm 62 years old. What's going to happen to me in a jail? Can they really put me in jail? Caller number 3. "Mr. Speer, they took my car. They took it about 2 weeks ago. Now, my neighbor has been driving me to work, but she can't keep driving me to work. It's just not going to work out. I'm going to lose my job. What happened? What happened?" I'm going to ask the person. "Well, I borrowed $2,000 from a car title lender. They told me it was going to be 25% interest. I thought that was pretty bad. But I thought I could afford it. They told me the first payment was going to be $87 a month. I figured I could make that payment. Come to find out, it's 25% a month, not a year. And the payment's $87 for the first month, but then it's $500 a month, every month. And I've been trying to make the payments. I've been doing this for 8 months. I've now paid back about $3,500 on that $2,000 loan. But I'm behind. They tell me now I owe over $3,000, even though I borrowed $2,000 and I paid back $3,000. How can that be? I tried to raised some of the money from my church, from friends, to get my car back. I went to the car title lender, and they said that wasn't enough. Because now there's storage fees, and there's repossession fees, and there's reinstatement fees that they're adding on. So I can't get my car back. And finally, my last story, and I remember this call very vividly just a couple months ago. I got a car title loan under Virginia's brand new Car Title Loan Act. I made about 3 payments. I got a little bit behind. I asked them, I said, can I pay late? No, you cannot pay late. You must pay on time. So yesterday, I opened up the door, and there is 2 ladies from the car title loan store. And my daughter was right behind me when I answered the door, my 10-year-old daughter. These 2 ladies pointed to my car, and they said, we can take your car whenever we want. You need to pay us, because we're going to take your car whenever we want. My daughter cried all night, because Mommy's going to lose the car, Mommy's going to lose her job, and we'll have to move. These are 4 of the, excuse me a minute. These are 4 typical stories that we hear all the time on our hotline. And what it tells me in my work, legislative work, is you cannot just intellectualize this issue. And we can all pretend that it's an interesting academic issue, but the impact on people is unbelievable. So, what is my perspective on the legislative process? Or another way could be terming this, you could title my talk is, what's it like to be David and fight Goliath, but not even have a slingshot? Are we trying to ban small loans or payday loans or car title loans? Every time I go down to the General Assembly, and at least 10 times yesterday, I was accused of that. I know they weren't specifically accusing me, but they're accusing advocates of that, right? We're trying to ban this. And there was a whole talk yesterday about how you shouldn't ban things. But the truth is, we never try to ban anything. What starts the legislative process in Virginia and what it starts in basically every state, is that the payday lenders or the car title lenders come in and try to change the law. They're the one that starts what we have in Virginia, a Consumer Finance Act that has been in place for decades. Or it used to be referred to as the Small Loan Act. It allows 36% interest on loans. And that's been in place forever. But what starts the battle is not people like me coming in and saying, let's ban payday loans. It's the payday lenders coming in and saying, and in Virginia it was in the year 2000, they came in and they said, we need an exemption. And that's how the legislative battles start. It's not people trying to ban it, it's people trying to get the exemption from what's been the law for decades. So, in Virginia, let me give you a little bit of a quick history. I'm probably already running out of time, but it started in 2000 with the payday lenders coming in and telling us that they were already doing payday loans. There were lots of payday loan stores in Tidewater near the military bases. A favorite target of predatory lenders are the military. They were already doing it. They were partnering with national banks. So what they told the legislature is, you cannot stop us. You cannot regulate us because we're partnering with national banks. And so please regulate us. Anybody who works on payday loan issues anywhere in this country knows that is a big danger sign. Whenever they come in and say, please regulate us, what they mean is pass a law that that legitimizes everything we are doing exactly the way we are doing it. And that means, that's what their reference when they say, please regulate us. So, for the last 11 years now, I have been fighting for these bills, either for them or against these bills in the Virginia legislature. We have had skirmishes. We have had all-out fights to the death, take no prisoner wars. And most recently, we had a mostly compromised bill with lots of sporadic firefights. In 2002, as I say, it started with the payday lender saying, we're renting bank charters and you can't stop us. And they basically rolled over us in the year 2000. The legislature did spend a year studying this issue. We had 2 or 3 meetings where people got a chance to have their say. But what we ended up with in 2002 was a payday loan. We now have a Virginia Payday Loan Act, which is still in place. There were some very small bones thrown to those of us who were complaining about payday loans. Probably one of the most important things that was put into that law was it came about because people like me were complaining and said, what's going to happen with payday loans is it's not a one-time thing. They're going to roll everybody over repeatedly. Even though they're down here telling you repeatedly that it's a one-time thing, that it's a short-term loan, it's not a short-term loan. The whole business model is intended to make you fail so that they can flip you from loan to loan to loan. It's not because I was all that smart. It's because other folks from other states were telling me what the payday lenders were going to do. So we complained and complained about this. The legislators listened to us. The payday lenders said, okay, let's put in the law that we wrote, the payday lenders, you cannot renew, roll over, or refinance a payday loan. Okay? That'll take care of the problem, right? Cannot renew, roll over, or refinance a payday loan. Little did I know then that they already knew exactly how to get around that. Do you remember the first story I told where the woman goes in and she pushed the $500, $75 across the table. They take the $75 and they push it back. Well, according to the payday lenders, that's not a renewal or a rollover or a refinance. And according to our regulator in Virginia, it wasn't. At least they never took any action on it. We estimate that 90% of the loans made in Virginia were, in fact, that type of loan, where they were rolling it over. We decided as a group of legal aid attorneys that we thought that was ridiculous. We fought it in court. We filed many, many cases on this, won almost every single case. Finally, a payday lender was dumb enough to appeal it to the Virginia Supreme Court. And just this year, the Virginia Supreme Court ruled that yes, if it looks like a duck and quacks like a duck, it is a duck, and it is a rollover, it is a renewal, and therefore that the lady that brought this case was a Social Security recipient who had gotten 33 payday loans in a row. 33 months of payday loans. Now that may be shocking to you, but that is just normal to me. Because Social Security recipients are typically in these loans as much as 2, maybe 3 years. Short-term loan, I don't think so. Back to the legislative battles. Between 2002 and 2008, we had lots of skirmishes. We had 36% rate cap bills. We had reform bills that the payday lenders put in. Probably the high point for us was and I don't remember what year it was, when we had a 72% interest rate cap passed by our House of Delegates. The payday lending industry went into total chaos over that, and that was actually put onto a reform bill that the payday lenders were bringing, and so they had to jerk that bill. And what you might find very interesting about that particular rate cap and this whole legislative fight in general, I have 5 minutes, is it's a very bipartisan fight. And the vote on that 72% cap was typical. About half the Republicans in the House voted for that cap, and about half the Democrats voted for it. And about half the Republicans voted against it, and about half the Democrats voted against it. And that's typical of how this fight has been. We have worked with Democrats and Republicans. Probably our biggest supporters over the years have been Republicans in the House. Our biggest supporter, who just retired this year, is Harvey Morgan. Harvey Morgan is a delegate from Gloucester. Harvey patroned the payday loan bill in 2002. A few years later thought much better of it and became an advocate on our side and tried to roll back what he had done. Real quickly, the last few minutes I have, I'm going to tell you a little bit about car title lending. over these 11 years, the car title lenders have been putting in bills, and we've been putting in bills, and then we each have agreed to basically dismiss our bills, if there is such a thing. All along waiting for the day that we would fight over car title loans. And finally, in 2009, they put together again, another year-long study of car title loans where we had maybe 3 or 4 legislative meetings where a lot of people got to speak. A lot of the issues were aired. What wound up happening in the 2010 General Assembly is that we basically wrote a bill that was changed. It passed the House. We really didn't like it, but we held our nose and we asked people to vote for it. Excuse me, it passed the Senate first. Then it goes over to the House. Now, again, another little tidbit about the legislative process is we then heard through the grapevine that this bill had been changed significantly. But the patron would not tell us what the changes were. And now you may think to yourself, that's crazy. But guess what? There's nothing that says he's got to tell us. And we knew it was coming before a House committee with the changes that we would not see until the day we walked in there. And we begged, borrowed, and pleaded, and finally got about 2 hours to see that bill. About 2 hours before that committee meeting started, we got a chance to see that bill. And then we had a debate about it. In the House, it changed again. We again held our nose and asked people to vote for it. And that's how we came about with a car title loan bill in Virginia. There's more to that story, but I'm run out of time. But let me just tell you quickly. There are some good things in our car title loan bill. There are some good things maybe in our payday loan bill that has been reformed. There are some. The payday lenders hate the payday loan bill that we passed. The payday lending has dropped 80% in Virginia. So you might think to yourself, well, they must have put an interest rate cap on payday loans, right? No. What we did was what I consider to be fairly minor things. Like, for instance, we made the payday lenders give the borrower 2 pay periods to pay back their loans. That, I think, is what the payday lenders hate the most. Because one of their best borrowers is the person on Social Security who gets 12 loans a year and can never get out because the typical Social Security recipient never gets any extra money anywhere, can't work overtime or anything like that, and is stuck. And as a former payday loan branch manager told me, they would salivate when they saw the Social Security recipients coming in for loans because they knew they could keep them in the loans for years. This new law cuts those loans in half. These people can only get loans every 61 days, so they can only get 6 loans a year from Social Security recipients. And I think that's one of the main reasons why they hate the making wait 2 pay periods, because they're still getting the same interest rate. And finally, the last thing I want to say is, I think there was some comment about you should keep in mind certain things. One thing that is always said to us is that we're trying to ban the industry, right? They say, if we want a 36% cap, they say, you're trying to ban the industry, right? If you want 8 loans a year, you're banning the industry. I mean, whatever it is that we propose, we're trying to ban the industry. And so you think to yourself, we can have discussions about what is the proper way to regulate this industry, but it can't be just what the payday and the car title lenders want, because everything else is banning. That's not a fair argument. Thank you.
Does that work okay? Everybody hear me? Well, Jay, thank you for that warm introduction. I have to say to Mallory and Christine, and certainly to Professors Howard, Wilson, and Fairfield, you all have done a remarkable job, and I'm extraordinarily proud of Washington and Lee. And I think the fact that Jay and I are both here sitting next to each other is testament to somebody's courage and maybe a little foresight. But thank you all very much for working so hard on this. I'm the token non-academic that did submit a paper, and as somebody told me last night, mine is the one with all the pictures, no Latin, and no formulas with squiggly stuff. So there's a paper in there somewhere, but it's easy to recognize. I was told a long time ago that everybody has anxiety dreams, and I've had one ever since law school. And it recurs, like anxiety dreams, I guess, do, very frequently. And mine is that in order to graduate from law school, I have to finish my moot court argument. And so I stand up and I say, "May it please the court." I'm immediately interrupted, like you're supposed to do in moot court. I never finish. I never graduate from law school. I'm a 54-year-old standing in a moot courtroom just like this. So please, nobody interrupt me in the next 10 minutes. I think that we do consumers, especially working middle-class families, an enormous disservice in the way we talk about short-term credit, and more particularly the way it's regulated. And to start with, let me be clear about the short-term credit market as I understand it. To call it a fringe market is a massive understatement. The tremendous demand for this type of credit is met by late payments to vendors, overdraft protection, NSF availability from banks and credit unions, unsecured cash advances from cash advance centers, check cashers, and online lenders, unsecured consumer installment loans, and secured loans like those offered by pawn lenders and title lenders. On an annual basis, we're talking about 1.5 billion transactions by 50 to 60 million households, generating upwards of $50 billion in fees. This, in my judgment, is not fringe. It's the heart of the consumer credit market outside of credit cards. The question put to us is whether and how payday loans should be regulated. And as to whether, despite Jay's admonition, I would say that it's positively yes. This market has to be regulated. The trick is how. And in my judgment, any appropriate regulatory framework that best serves consumers by balancing access to credit with affordability of that credit should be based on three principles. The first is full disclosure and transparency. The second is one that treats similar products similarly. And third, one that provides a clear, unsubsidized credit migration such that consumers can move seamlessly through various credit products that appropriately meet their needs. First is the full disclosure and transparency. Professor Warren often points out that consumers need a full measure of clarity about what they're buying. Measured by this standard, the notion of an annual percentage rate alone as a measure of short-term credit fails miserably. It's like walking into a grocery store to buy hamburger meat and having the price quoted by the ton. Pulling into a parking space in a downtown area, and instead of having 50 cents an hour on the meter, it says you pay $4,380 a year. Consumers have every right to know annual percentage rate, but what informs their choice of credit should be APR and simple dollar cost. Any other fees, origination fees, administrative fees, credit life insurance, membership fees, prepayment penalties, should all be included in both simple dollar cost and APR. They should be disclosed on payday loans, APR and simple dollar cost, should be disclosed on overdraft products, should be disclosed on NSF products. Second, treat similar products similarly. Make no mistake, the payday advance product that is so easily vilified is, especially in the customer's eyes, virtually the same product as overdraft privilege or balance protection. The painful legal distinctions between the two that are often trotted out are just that. They are distinctions with very little difference. For a regulatory framework to differentiate products based on an extrapolated interest rate is entirely misleading to the customer. On average, the nationwide fee for a payday advance is about $15 per $100 advance. The fees on $100, the NSF fees, are on average about $65. The fees on a $100 overdraft product are about $30. Payday advance industry exists primarily because of this price disparity. Payday advance is half the price of an ODP transaction, and less than a quarter of the price of an NSF check. I think here it's important, especially today, to step back and be clear about what is happening in the NSF and ODP markets. Banks and credit unions, as Ronald Mann pointed out, have become wholly dependent on fee income to remain solvent. Overdraft revenue as a percentage of net operating revenue at large commercial banks is almost 25%. At community banks, it's over 50%. At credit unions, it approaches 75%. I was told by a community banker in Texas, if overdraft privilege and NSF fee were regulated to $10 per occurrence, 90% of the community banks in Texas would fail. No different in the credit union world. At Navy Federal Credit Union, for example, an NSF ODP fee per active user, that is to say the folks who use it 1 to 4 times annually, the average fees incurred per user are $450. That's the equivalent of 10 $300 payday loans. 70% of credit unions have courtesy overdraft programs. 70%. That includes the White House Credit Union, the Senate Credit Union, the Pentagon Credit Union, the Navy Federal Credit Union, as well as Beacon Credit Union right here in Rockbridge County. Beacon charges a $35 ODP fee with no limit on the number of transactions per week or per day. So when last Saturday, which was finally called Bank Transfer Day, 40,000 people switched their accounts to credit unions from commercial banks. It's been approximately 700,000 people since the $5 debit fiasco for Bank of America. All these folks who have switched to credit unions are almost twice as likely now to participate in courtesy pay or ODP programs, possibly incurring more fees than they had at a commercial bank. Before I move to the credit migration point, let me say emphatically, I'm not being critical of either credit unions or banks, nor do I believe ODP is necessarily a bad thing. Neither do consumers. As somebody pointed out yesterday, when the Dodd-Frank mandated opt-in requirement went into effect July the 1st, most observers critical of bank and credit union practices estimated that fewer than 20% of customers would opt in. That number is closer to 75%. Why? Because if you're standing in the checkout line at Walmart and you have $120 worth of groceries and $100 in your account, most folks would rather have the bank cover the $20 difference than get out of line, put the groceries back. So, is a $30 fee worth a $20 extension of credit? In most places, of course it is. Spartanburg, where I live, a merchant can and usually does refer a bad check to what's called the solicitor's worthless check program. Check writer has to pay back the face value of the check, plus a $40 fee to the merchant, plus a $91 processing fee to the county. That's $141 to clear up a $20 problem. This or something like this happens 1 billion times a year to tens of millions of working middle class families, and on average at about $60 an occurrence. So what to do about all of this? In my judgment, overreaching by the industry and overzealous rhetoric by consumer groups has led to overburdensome or at least misdirected regulation. And it just simply prevents consumers from being well served. One solution, at least in my view, would be to move beyond the poisonous rhetoric and reputation risk politics and allow bank and non-bank entities to collaborate on a short-term credit continuum. Such a collaboration should have 3 objectives. The first is to move non-bank customers into the mainstream of either a bank or credit union relationship. Second, migrate higher risk customers from high cost products to prime or near prime products based on actual repayment experience and not FICO scores. Third would be to marry insured bank status, which allows for savings vehicles, higher dollar products like mortgages and business loans, to the non-bank, consumer-focused, innovative product mix in smaller neighborhood locations. A, quote, neighborhood financial services center that provides check cashing, money transfer, microcredit loans, prepaid debit cards, together with access to mortgage loans, business loans, student loans, and savings products, and other traditional secured and unsecured products, would leverage the physical plant cost structure of non-banks with the cost of capital insured status of banks. To serve and preserve the United States market for small denomination credit, we have to move beyond the malicious fiction that numbers like APR perpetuate and find a better way to serve the almost $1 trillion market for consumer credit. Thank you.
Can you get on there? Okay, well, I'll get started while we're sorting things out here. This is a fantastic panel to be a part of. I'm really pleased how it all came together. I am one of the behavioral economists Ron Mann alluded to, doing basically providing pieces of empirical evidence on how people use payday loans. And last night Hilary accused me of being the poster child for agnosticism. It sounds like that was actually not an insult, but a compliment, I guess. But I have done now enough work on payday loans and how people use them to start thinking about the ways in which regulation might help people use payday loans. So, it's okay. Oh, it's coming. Okay. There we go. Okay, so today I'm going to give you just a snapshot of some of my more recent work on how people use payday loans and talk about how that fits in or doesn't fit in with what current different kinds of regulatory schemes exist. So I'll talk a bit about bans, price caps, restrictions on the size of loans that you can take is one of the latest pieces of scholarship I'm working on. How loan lengths affect people's default and repayment behavior, and then also to talk a bit about the importance of information disclosures and also rollover restrictions. I'm going to start though with a little bit of behavioral economics. So as not just as a behavioral economist, but as an economist, I have sort of a general paradigm for thinking about how people make decisions and how people make complicated decisions that involve intertemporal choice, so very difficult trade-offs over time. So I like to think about this in the framework of Gary Becker's early work on rational addiction. And there's a lot of parts here that have nothing to do with payday loans, but some of the important trade-offs that you think about when we try to model and understand smoker behavior, for example. A lot of that is not dissimilar to payday loans. So addiction has a couple elements to it, some very complicated psychological and neurological elements that we're not going to think about. But if you think about smoking, for example, there's a couple of main elements. One is reinforcement. So if you smoked yesterday, you're going to be more likely to smoke tomorrow. Another is tolerance. So if you smoke 1 cigarette today, you're going to have to smoke, say, 2 cigarettes next week to get the same buzz. The crux of rational addiction, so the model assumes people know about reinforcement, know about tolerance, and also are rational, forward-looking agents. And that people will maximize their utility given 1, 2, and 3. So Gary Becker, I think, really truly believes that smokers make decisions rational. They have all the information about the consequences of smoking. So then, from here, if you're a very libertarian economist, you would say the only only rationality for regulation would be negative externalities. So, and that is an empirical question, right? So we don't think smokers are harming themselves. They're rationally choosing to smoke. So we're only concerned about negative externalities that smokers provide. So fast forward about 15 years, and now behavioral economists are starting to think about more complicated ways that people make intertemporal choice decisions. So I'm borrowing this from work by a couple of economists, John Gruber and Boton Kozegi. They also look at rational addiction, and besides the fact that they include tolerance, reinforcement, and forward-looking behavior, they also include elements of self-control problems in myopia. And there you get much more reasonable predictions about how smokers make decisions. And from that, you get not only rationality for regulation based on negative externalities, but now it's based on what we call internalities. People are harming themselves. So you could think about your today self, your tomorrow self, your 1 year from now self that's addicted to smoking. We're going to try to choose one self's preferences, most likely your non-smoker self, and try to implement those. And so I think that as an economist, I come to the table with all of my evidence on how people use payday loans in thinking about to what extent we actually want to be paternalistic, and that matters. And that depends on whether or not people are actually making mistakes. Whether or not people are making mistakes in their borrowing, you have to have some starting point for that. So I start off with thinking about to what extent are people rational. Is it the case that, as in some cases with smoking, people would be better off never having used payday loans to begin with? And these are complicated issues, but that's my starting point for thinking about these. So there's sort of a quantum leap between this theoretical work in behavioral economics and regulation on the ground. In these models, you would literally tax people at individual rates to get them to pervert their trade-offs between today and tomorrow. And this very sort of theoretical way of taxing people to stop them from smoking that really is, has little to do with the way we could actually implement them. So let's talk about, I'll give you some ideas about where my work has had something to say about regulation of payday loans, and then we'll get back to some of these issues in a minute. So actually I have thought a lot about banning payday loans at interest rate caps, which we heard earlier, basically constraining payday lenders to charge significantly lower APRs is basically the same as banning payday loans. Payday lenders won't be willing to operate those. So I put these in the same category. And as Hilary alluded to John's article on the overall evidence of whether or not payday loans are good or bad, some of which comes from my own work, we really have no good evidence about, in the big picture, are payday loans good or bad. So there's, in my mind, no reason to ban payday loans. Another interesting aspect that I think people don't think about too much is the size of loans, and does it matter? So I've actually done some recent work on this very question. And it relates to a much older literature on moral hazard, which is probably a bit tangential to the discussion today, but it fits into the bigger picture of why I think this is important. So So in a recent paper, I'm looking at the extent to which there's moral hazard or adverse selection in payday loans. So moral hazard would suggest that if you give people larger payday loans, they're going to be more likely to default. So they, if you give someone $500 instead of $200, they're going to be more likely to run away with the $500. And there's complicated dynamics for why that might be the case. And adverse selection would suggest that there's some private information borrowers have that lenders can't observe. So offering someone a larger loan, you're going to get worse kind of borrowers who have some kind of private information about themselves. So what I do is, there we go. I want to look at the effect that actually the size of loan has on
repayment outcomes. And the way that I do this, and as I said, this is kind of pieces of these evidence-based parts of a puzzle I hope will come together to give you a better picture of how people use payday loans. I exploit the fact that many firms allow people to borrow only half of their net take-home pay. So if you get paid $600, you can borrow $300. Many firms offer payday loans only in $50 increments. So if you combine those two facts, you get very similar kind of borrowers who get different sizes of loans, much larger differences than the differences in their paycheck. So if you earn $600, you get a $300 loan. If you earn $599, you could get half of that, except half of that would be $298.50, but they only give loans in $50 increments. So you have these two people that make $1 difference income get $50 different loans. So that's almost like a nice experiment for us to look at different loan sizes. So you can think about this just graphically. I show here this discrete function that shows you the size of loan matched with the amount that you earn. So you could think about me comparing people, similar incomes on different steps. And what I found was very surprising results. So I found strong evidence against moral hazard. Actually, people who had, I just put this in terms of $100 loans, but you could kind of scale this up or down. This kind of random assignment of a $100 loan would decrease the probability of default by about 4 percentage points. And I also find strong evidence of adverse selection. So choosing a larger loan makes you much more likely to default. So there is strong adverse selection, but something about larger loans actually help people repay rather than defaulting on their loan. As an aside, I also find strong evidence of liquidity constraints. So you can take these results and from there figure out if you were theoretically to offer someone $1 extra payday loan, how much would they end up borrowing? The typical numbers you find for these kind of studies on things like credit cards is between 10 and 15%. We find that people borrow 50 cents on the dollar of payday loan. So that suggests that actually people do want to borrow more in their liquidity constraint. So I think that to me suggests that actually larger loans might help consumers avoid getting into multiple repayment cycles. It could be the case that offering a person one $500 loan rather than two smaller loans will help them manage their finances better. Second thing I want to mention is research I'm doing on how the length of the loan matters. So this is going to have another kind of empirical exploitation of sort of a random assignment here. So there's a lot in this figure, so let me unpack it for you. I should say first, payday loans are due on your payday, right? So and in different states, there's regulations about the length of the payday loan. Some states, you can't get a payday loan for less than 7 days. Sometimes you can't get a loan less than 14 days. So suppose you're in a 7-day state and you come 6 days before your payday loan to the payday lender. You can't get a 6-day loan, so you're going to get till your following payday, which would be a 13-day loan. Compare that to the person who came in 1 day before. They will get a loan, a 7-day loan. So you get these similar kinds of people getting very different sized loans. So actually the most dramatic effects are with the 14-day borrowers. If you're paid bi-weekly, depending on when people come in during the month and the days of the month, you get these nice discontinuities in the length of the loan. But what I find, and I'll explain the figure in a second, is basically repayment rates were completely independent of the loan length. So I've shown here the days of the week, which basically just helps me plot out the average loan length per person and the probability of repayment. The probability of repayment hovers almost exactly around 50%, whether or not your loan is 7 days to 21 days. And you see there as the loan lengths are jumping up and down. So I've cut this a lot of different ways, looking at specific industries, Social Security recipients. Actually, it doesn't look like giving someone 1 month or 2 months will make a big difference. So it's hard to extrapolate that to something like installment loans, for example, which are much longer in length. But I was quite surprised to find out that the difference between 6 days and 25 days to repay your loan doesn't seem to be big. Okay, so the last couple of things I want to mention are information disclosures. I actually think there's a lot of confusion, not about payday loans, but about people's future borrowing behavior. So I like payday loans because they are simple, they're not complicated. Even if people don't understand APRs, which I'm sure they don't, I don't understand how APRs work often, people understand that they owe the payday lender $50 in interest next week. So you can really make an as-if argument. So Milton Friedman, 50 years ago, talked about pool players who operate as if they're doing very complicated geometry and physics. You can think the same thing about consumers. We don't understand exactly how APRs work, but we understand the dynamics and the trade-offs. So I think in this case, to the extent that there's a problem with people using payday loans, it's irrationally, it has to do with the fact that they mispredict their future time preferences or their self-control problems. So they either mispredict how difficult it's going to be to come up with $500 plus $75 out of their paycheck, or they misunderstand how frequently they're going to be getting shocks that will lead them to need to borrow on payday loans. So I have work on this, documenting these self-control problems of payday loan borrowers and their misprediction of consumption shocks. And also there's evidence that suggests some kind of information disclosures that are not the typical ones you might think of work. So Ron Mann alluded to the work by Bertrand and Morse. In one of their field experiments, they show that when you give people information on how, something like borrowers like you are on average going to borrow 10 more times this year, that kind of usage information disclosure does seem to help people borrow on payday loans. Okay, so just a few reflections on, the couple papers I've alluded to here in my larger body of work. Bans, I think, are misguided. Price caps are the same as bans. I think larger loans might actually be better given my results on the opposite of moral hazard. Of course, then the problem is that there's big adverse selection problems that lenders will be facing. Loan lengths don't seem to matter, so I don't think that's a good margin in which we might be thinking about. Information disclosures are useless unless you're trying to help people understand their likely future borrowing behavior. Just like in the studies of addiction or savings or other kind of intertemporal choice issues, behavioral economists have documented very precise and strong elements of myopia and misprediction of your future preferences. And I think that I'm not so agnostic that I would say I can't say if rolling over a loan 33 times is good or bad, as was brought up earlier. I do think it is the case that it's easy to show that some people, just like some smokers, some people do use payday loans irrationally and are making a mistake. But some people, just like some smokers, use them rationally. So to the extent we think payday loans should be, for short-term credit, restrictions on rollovers will be a good thing. Okay, so in conclusion, I think people want and like payday loans. If we ban payday loans, which many states have, people will find another way to borrow on short-term credit, which could be a worse alternative. So that's one thing that doesn't come up as much as it should in policy debates. Credit can be a good thing. Even at 500% APR, it allows people to smooth their consumption, an unequivocal good thing if it's used correctly. People use payday loans even when cheaper credit is available. So I have work documenting the fact that people use payday loans when they have credit card debt available, when they have cash in their checking account, when they have a credit line at their credit union, people use payday loans. So there's a lot of kind of revealed preference that people like payday loans. I think they're transparent and simple. I think what's not transparent and simple is people's ability to repay the loan in 2 weeks. So just on the face of it, I don't think there's anything wrong with payday loans. I think the problem is the mispredictions about future behavior. Coming up with the interest and the repayment and the principal is much harder than people predict for a number of complicated reasons, all of which I'm, have been or am currently working on. So I'll stop there. Thanks.
Well, my name is Chris Peterson. I'm a law professor at the University of Utah. I want to start out by saying some thank yous. First, I want to thank Professor Hawkins and Professor Martin and Professor Brockauer for putting the proposal for this symposium together. I think it's a wonderful symposium. I'd also like to thank Christine Shepard and Mallory Sullivan especially Mallory Sullivan for, in particular, indulging my truancy and getting my paper in on time. I'd also like to thank Professors Howard and Wilson for their hospitality and for making themselves so welcoming to us. And also Lisa Gerhardt and Wendy Rice for their work in handling a lot of the logistics. And I'm sure there are a bunch of other people that I don't know about. I'd also like to thank my co-panelists, in particular our colleagues from the industry that came and are joining us. I think it's really honorable for you to come and share your perspective, and you seem like great guys. I want to also apologize to you in advance because I think there are probably some things that I say that might be a little bit hurtful a little bit. But I want you to know that it's not personal, and that it's just my perspective on the law and policy in the world, and that I'd still be happy to have a beer with you after.
Rest easy. You won't be the first person.
All right. Well, last thing I want to say is I want to express what an honor I feel like it is to be here. It's such a venerable institution. Being a Westerner, I grew up out in the desert and the mountains. It's a little bit inspiring for me to come back and see some of the founding majesty and grandeur of our country on this side of the country, and in particular this institution. I mean, an institution that gets to claim George Washington as sort of a benefactor of their institution. I mean, that's not happening out in Salt Lake City. We have a lot of advantages at our university that people don't perhaps realize. But that being said, I thought maybe it would be a good place to start with what General Washington thought about consumer loans. And here's what he said. He said, there is no practice more dangerous than borrowing money. For when money can be had in this way, repayment is seldom thought of in time. Why are my slides not advancing? Oh, there it is. Repayment is seldom thought of in time. Exertions to raise it by dint of industry ceases. It comes easily and is spent freely, and many things indulged in that would never be thought of if to be purchased by the sweat of the brow. In the meantime, the debt is accumulating like a snowball is rolling. Wow, that's a behavioralist right there, isn't it? I mean, how many different behavioral heuristics did he put in that one paragraph? And all without the aid of a multivariate regression analysis. They took that to heart back then too, because here in the great state of Commonwealth of Virginia, at the founding of the republic, they had imposed a 5% interest rate cap, a very aggressive intervention in the marketplace. Payday loans that were not only illegal, but a lot of credit card loans and most home mortgages were illegal because of their concern about the effects of these types of loans. It wasn't just Virginia, although Virginia was a little more pious in that respect than other states. Up north in Connecticut, 6%. Delaware was 6%. Georgia had an 8% cap. But all 13 original colonies capped interest rates aggressively and did not tolerate this type of lending. Perhaps that had something to do with the traditional American values that we share. Look, more than a dozen biblical passages suggest that usury is a grave and serious sin. I'll only preach one. Hath given forth upon usury, hath taken increase, shall he then live? He shall not live. He hath done all these abominations, he shall surely die. His blood shall be upon him. That's Ezekiel. Now, ironically, oftentimes the folks that I talk to that are in the industry are people of faith. I'm not a particularly religious guy. I got too much of that when I was a kid. But I do recognize that book is a repository of our shared values, and one departs from those values only with great caution, I should think, because they tell us something that's profound and important about our world. I think what that passage says, I think that says that if you're a usurer, if you're a predatory lender, you're going to hell. I mean, isn't that? That's what it says. And I know that we've been preaching in the Church of Agnosticism, but it turns out that 72% of Americans believe that imposing traditional usury limits on consumer finance markets is the appropriate policy. An overwhelming majority of people in this country do not agree with the free market deregulated approach. And I think most of them are not agnostics, although I am. You know, I just wanted to sort of put out some of those facts out there on the table so I don't look so radical. My question that I want to start with or focus on today is what can local government leaders who share the traditional American view of usurious lending do to protect their families? So I'm going to focus on local government leaders just because I think it's something that hasn't been talked about as much. I'm going to look at a little bit of legal background, some market inefficiency points, a signage proposal that's in my paper that I think is maybe a better taps out the power that local governments have than perhaps some of the strategies they've been using in the past, and then a little bit of legal analysis about why I think that that's statutorily and constitutionally protected. First, my legal background. I think there are 4 periods of usury law in the United States. The first is the long-standing colonial thrift ethic era where general usury limits of the range that I just talked about were in place. And that's the oldest and the longest period of law in our country from the founding of the Republic all the way up to the end of the 19th century. There were relatively few exceptions. There were certainly pockets of time where lenders were using creative strategies to evade those usury limits, but they were a hunted and smaller minority. I think that's just a historical fact. In the beginning of the 20th century, we entered a period of special usury laws, particularly following the reform work of the Russell Sage Foundation, which advocated small loan limits or higher interest rate limits on small loans, ranging from between 18 to upwards of about 45-48% per annum, with a 36% cap being the norm and the typical rate in all the country. Throughout society, throughout American history, the vast majority of states and time have capped interest rates in those ranges, with only a few exceptions. There's some exceptions that there's some states that tinkered with it in the mid-19th century. The western states oftentimes wouldn't get themselves organized when they were still, shooting each other and riding around on horses. They wouldn't get their interest rate caps set up for a little while. But America has been a usury capping state up until a deregulatory period, which really began in earnest with the Supreme Court's decision in the Marquette case in 1978, which allowed banks to export the lack of an interest rate cap in the bank's home state to the borrower's home state that nevertheless has an interest rate cap. Once that happened, there was tremendous incentive for relaxing interest rates to keep your bank jobs. And once the deregulated environment applied to all the banks, it was harder for for state legislatures to turn away charismatic and persuasive lobbying efforts by non-bank lenders that also wanted to have opportunities to charge higher interest rates, since the banks had the chance to do that. Once that happened, our interest rate caps largely eliminated. Here's a chart from another study I did that shows median annual percentage rates, limits of state usury laws on typical payday loans in 1965 to 2007. Across every region in the country, it was 36%, except for the Northeast, where there was a 30% cap. But that's all changed by 2007, going between 94% in the Northeast up to 521% out where I live. The national median cap, though, is about 391%. And of course, once that happened, there was a huge increase in payday lending. This charts the difference between payday loan outlet growth and Starbucks outlet growth from the 1990s to 2005. Your industry just kicked the tail of Starbucks in terms of opening up new retail outlets. There's clearly tremendous demand for it. Here, this is a chart that roughly shows where the locations are. Maybe not all that interesting for our purposes today. And here's a chart that compares payday lenders to McDonald's. It shows the difference between the two. So the red states, what we're talking about is you add up all the payday lenders and then subtract all the Starbucks locations. That's the number that's left over. So here in down in Mississippi is the highest density, 976 more payday lenders than there are McDonald's locations around the country, around that state. So one thing that Mr. Webster and I can clearly agree on is that it is no longer, although it probably was when Professor Kasky wrote his book, it is just simply no longer accurate to characterize this industry as a fringe industry. That's just not true. It is a mainstream industry. Would we say that McDonald's is a fringe restaurant? No, it's the largest restaurant in the country, and McDonald's has nowhere near the geographic bricks and mortar presence that the payday lending industry does. It is not a fringe industry. We should not characterize it as such because it allows us to put that off as to the side as though it's an inconvenient sort of thing. Well, there's the poor folks. They have their fringe things. Oh, how are we going to deal with that problem? No. This is mainstream. It's a mainstream industry. We have also, I think now, in the past 5 years entered what I think is a new period in our usury law history, a reformative period, most prominently signaled by the Congress's capping of interest rates on loans to military service members at 36%, but also by retrenchment of traditional usury laws in North Carolina, Georgia, New Hampshire, Oregon. Who am I forgetting that switched back? What's that? Oh, Montana. Big sky country. They're great law. Arizona switching back. So a lot of states have been switching back to more traditional usury limits. But interestingly, in the states that haven't succeeded in doing that, there are now about at least 130 different ordinances and resolutions that I've identified around the country where county governments and city governments are trying to do something about this problem. They take, or what they perceive to be this problem. They take a variety of different approaches. Some of them are merely resolutions calling on the state legislature to reassert traditional usury limits. Others are using zoning ordinances that I tend to think are well-meaning, are well-intentioned, but probably just create barriers to entry that don't really particularly facilitate better consumer protection. The zoning limits are usually only enacted after the city is saturated with payday lenders, or more than enough payday lenders to service all of the demand in the industry. But they're not opposed by the industry because the people who already have a current stake in it are happy to have protection from entry by people who might actually price compete, although that's very rare in this industry. So I don't tend to see those as being particularly effective, although I do recognize that they're well-intentioned and that local government officials have to do something about this because their constituents demand it, and their own moral views and economic perspective on the world suggest that this is a necessary type of reform. Well, if that's the case then, if they need to do something, but they don't have the power to do what it is that they'd like to do, my paper is about presenting something that exists within their legal power that maybe is more consistent with their own objectives and goals. But before that, I guess we're talking so much about Jeremy Bentham that I maybe need to put in my little sort of cut at whether or not this market is performing efficiently. I think not, I tend to want to defer to Paige because she's a much better economist than me, and some of her own views influence mine as well. But I think that there are at least 7 different psychological patterns out there where there is growing and long-standing, in some cases, evidence that the market does not perform efficiently. The best case is probably unrealistic optimism. People are unrealistically optimistic about whether they will be able to succeed in repaying their debts. The research of Neil Weinstein, Sherry Taylor, and a host of other psychologists and behavioral economists suggests that people underestimate the risk of heart attacks, asthma, lung cancer, venereal disease, suicide, a whole host of other things, including their ability to repay debts. And in fact, those are job loss. Those are precisely the same things that are the leading cause of insolvency, as Professor Warren's research makes absolutely clear. So it strikes me that people underestimate the risk that they're not going to be able to repay that loan in 2 weeks. And if they and whatever we think about whether or not payday loans are cheaper or more expensive than other types of credit products, they are not cheaper if one makes the payday loan and then bounces the check on the payday loan and incurs the whole arena of things that one was trying to avoid by taking out the payday loan in the first place. At that point, the payday loan didn't do you any good except for punting you down the road 2 weeks and imposing an additional interest rate on you. So I tend to think that there's significant evidence that people are unrealistically optimistic. Natalie Martin's point-of-sale study, although not a statistically, it's a point-of-sale study, so it's very difficult to get representative samples, tends to show that payday loan borrowers are horribly optimistic about their ability to repay. And our own Professor Jim Hawkins is also going to present, I think, some evidence to that effect with respect to car title loans in Houston. With respect to, I also think people have present bias. They hyperbolically discount the value of future wealth. They want things today in a way that doesn't measure up with their own considered judgments about what value really is. People are compulsive. They want things faster than they should be able to get them. The research of David Laveson, George Lowenstein, Lawrence Ozobel, on a whole host of factors I think is compelling. Also, I think that people engage in distress-based reasoning, particularly Roy Bauminster's research and Gloria Keinen's research, so that people have limited attentional capacity. When they're in an emergency, they naturally sort of tend to satisfy to the first moderately acceptable option, and it's not clear that when they're in that spot, they're able to rationally compare all the different types of loans and force price competition in that marketplace. People also, oops, is this not, what happened?
You're going the wrong way.
You're going backwards.
Oh. People also have cognitive limits. I want to talk about all these things, but the Department of Education has found that 22% of our country is functionally innumerate. It has minimal quantitative literacy skills. So this means that on tests they cannot understand and can't apply the use of basic numbers in a piece of text. These folks have tremendous difficulty comparing the difference in prices and trying to understand a document that many of us might view as simple is actually quite complex for them. Also, I think that the notion that payday loans are simple is, in my view, a myth. Payday loans are not simple. Payday loans have a whole battery of contingent costs and expenses that are not encapsulated in that $15 fee that you're initially charging. Just taking a list of some fees that are included in some contracts that I happen to have in my office: default rates, service charges, insufficient funds fees, return check fees, collection costs, late fees, renewal fees, court costs, process service fees, filing fees, repossession fees, and attorney's fees, all included within just a small sample of contracts that I collected in my area. And all of those are in addition to the other costs that are associated with the payday loan that are not charged by the lender but are charged by other people in the event that you bounce that check. So I guess I'm running short on time, so I think I'm going to have to skip framing effects, loss aversion, and I'm going to maybe just mention addictive and compulsive behavior, because finance is fungible. When you take a loan out, it can ratchet into all of your other issues. So you can finance your small business, you can finance your education, you can also finance your gambling addiction and your alcohol addiction and your drug addiction, and all of those imperfections in our world get funneled into the payday loan market because it is the lowest sort of the least underwritten market. So if you are compelled to use heroin and you need a fix now, it's not that payday lending is per se inefficient, it's that heroin use is inefficient and payday loans gets to be a bridge towards that. So there is compelling evidence that oftentimes these loans are not efficient and this marketplace isn't working effectively. And if you don't want to trust me on it, take this quote. The overweening conceit, which the greater part of men have of their abilities as an ancient evil, remarked by the philosophers and moralists of all ages, the chance of gain is by every man more or less overvalued, and the chance of loss by most men undervalued. I think that's unrealistic optimism, and it's also Adam Smith from The Wealth of Nations. He also indicated that uncapped usury markets allow money to be lent to prodigals and projectors. Wow, that seems to me like prodigals, he's probably talking about hyperbolic discounting, and projectors, I think he's talking about unrealistic optimism. And those folks, when they get financing, they're just likely to waste and destroy capital overall. It's inefficient. So what did Adam Smith say? He said we should set user limits somewhat above the lowest market rate, which in a consumer market, if you're going to have a prime market, what is that? Maybe 18% on the upper end of credit cards, maybe 36% is just somewhat above that. So don't trust me, trust Adam Smith. He seemed like he was a pretty good economist. Here's my proposal. Local government should require, we're not going to get to my proposal, I spent too much time talking about inefficiency. I'm getting the cane here. It seems to me that, look, if we're not going to cap user limits, how about this? What about having ordinances that require a warning on storefront, street, and other on-premises signs that says, warning, predatory lender. Here's a picture of what it might look like. Quick loans, warning, predatory lender. Or here's one, instant loan, warning, predatory lender. Or how about lightning loan? That was a little bit small. Warning, predatory lender, it says under there. Well, it's not expensive for the industry to comply. It's consistent with the moral view of 72, 74% of Americans, and with the founding values of our republic. It seems like it's also probably, and here's another, I just have an explanatory door sign. It seems to me that 45% is a nice threshold to hang that on, in part because of Congress's judgment in the Consumer Credit Protection Act of 1968, where they said that an interest rate above 45% is per se evidence of extortionate lending. Also, in the state of Florida, for example, 45% is, without evidence of independent extortion, if you're not a licensed lender in Florida and you charge more than 45%, that's a felony usury, in a third-degree felony in the state of Florida, and 45% is the number they hinged it on. So I picked 45% as opposed to 36% just because I was trying to be reasonable and make sure that I'm making some fair compromises. Maybe 36% is a little bit too low. We might get a few more pawn shop loans between 36 and 45. But I think, in my view, and I think in the view of a majority of Americans, 45% is a pretty fair cutoff, and beyond that, frankly, it's a predatory loan. And I also think it's not preempted, even in, it's not preempted, I don't think, in either home rule or Dillon's rule states, and we could talk about the constitutional implications of it, but I think probably most folks here are more interested in the regulatory implications. The short version is that, this is a compelled commercial speech, which gets a lower standard of scrutiny than most forms of speech. It only has to be, what is it? It's reasonably related to consumer deception. All of the evidence that there are behavioral distortions in this market suggests that consumers are misperceiving the value of the product that they're purchasing, and that's within the scope of government to provide a fair, effective, compelling warning to them about the risks of their behavior. I'm finishing now. But first, one more comment about General Washington. We have in our society, I think, taken the word paternalism to be too pejorative than perhaps it deserves to be. Nobody likes paternalism because everybody, whoever gives you advice about something, your impulse when you get advice from them is to say, "You're not my daddy. You're not my dad. You can't tell me what to do." Only the reality is that people make poor decisions sometimes, and here's a guy who actually is your daddy in the sense of he's the father of the country, the benefactor of this university, and read the sentence and think about what wisdom that imparts for us. There is no practice more dangerous than borrowing money. Well, surely it's not too much to ask for a firm, compelling, salient warning to borrowers who are going to borrow money at the highest interest rates, despite the best advice of General Washington. Thank you.
We have some time to take questions from the audience. It would be better if these were questions rather than political statements. And I would call first on any professed co-religion as this is mine. Yes, sir.
Well, I don't know if I'm an agnostic about Payday loan, you all judge later, but I did want to maybe raise something with Paige. So I know in your descriptive statistics on the loan amount study, among other things, it reveals that 50 or 60% of people who take out payday loans eventually default on them, which doesn't seem like a good outcome. In your conclusion, where you say banning or restricting rates is a bad idea because essentially there's a need expressed, a utility expressed through revealed preferences. But you told us earlier that people have inconsistent preferences, right? They have a preference at the time they take out the loan, and then they have a different preference after they start to experience the consequences of the loan. So what are we really saying when we talk about the revealed preferences of payday borrowers if we don't sort of think about their preferences over time? I mean, do we know how people really feel about these loans after they've experienced them for a while, and does that change our view about, the idea of banning these products?
Well, my setup to talk about the example of cigarettes and addiction, I like that because economists there take a strong stand on what the welfare implications are, and they make strong normative claims, both the kind of rational actor types and behavioral economists, about which selves preferences we should implement.
Right.
And in that case, it's not that hard to argue that your non-smoker, long-run healthy self is the one that we want to implement. So you have to, I would make the same stand for payday lending, but that's just like I don't think all smokers are rational. I think a lot of people use payday lending rationally. So I'm not, I guess I was making less of a revealed preference argument, but I still think people act in generally very rationally consistent ways, not necessarily completely in line with the very rigid framework of rational actor model. But we can, suppose we think people are hyperbolic discounters, which itself is a very, constrained paradigm, but then that gives us explicit kind of normative implications for what, if anything, we want to do to help people avoid payday lending or smoking.
So a couple questions for Chris Peterson. First, you heard to be a little bit careful as you take the behavioral stories off the shelf and take the overall optimism story. You claim that people are underestimating the likelihood of paying their debt. Well, that's true. Money that you borrow and don't repay is free. So if that's what you're underestimating, you're actually going to borrow too little money, not too much money. You need to make a story that really what you're underestimating is that the likelihood that you will actually repay the debt at a difficult time to repay it. So you need a little bit more fine-tuned there. The second point, I'm going to pretend I'm a historian, which I'm not, you can correct me. But you paint the picture of sort of the pre-deregulation of the time of thrift, colonial thrift. Charles Warren estimated that about one out of every 200 Americans in the 1830s went to debtor's prison, which is about the same rate of bankruptcy today. David Kaplowitz in the studies of the 1960s estimates rates of garnishment or other debt collection activities that are many, many times the rates today. And I just encourage you to sort of be a little bit reluctant to compare the thrift of before to today. Of course, how do they do that? I mean, how do people get in trouble? Well, there's a usury restriction. There's an easy way around it. I just sell you goods on credit at an inflated price. I build, that's what I teach my students, right? I'm a law professor, so I try to teach them how to evade laws and get your clients what they want. I teach them that, this is a good way to evade usury laws.
Well, some great points. I actually don't think that I really disagree with anything you said. And with respect to the historical point, I mean, for some reason I seem to like to refocus us on historical figures from time to time in my speeches, more so than my speeches than in my writing. But I recognize that there's a context to all of that. There's a lot of lending that was going on. There was a lot of illegal lending back then, especially after the Civil War. But I refuse to take the position that because times have changed, I can no longer invoke the wisdom of our ages. The guy clearly is talking about, President Washington is clearly talking about behavioral distortions. This is a letter where he's giving some advice to his nephew. I think it's appropriate to talk about it, and I don't feel bad about the fact that there was a lot of debtors' prisons and there are a lot of dodges to usury limits back then as there are now. I know that. I don't think that. My view is that it's still a legitimate point. And as far as the point, the first point about whether or not I need a little bit more careful about unrealistic optimism, that's probably right. Yes, ma'am.
My question is directed to Paige, and it's about asking you to direct your research toward the issue of partial payments. Because Professor Natalie Martin, she's actually done the surveys of people who got the payday loan. And, I've been studying this myself, and one of the things that consumers are shocked to find out is that they're paying all these rollover fees, and yet none of these fees count towards reducing the principal. And so I think that you need to be asking the question in terms of the consumer's ultimate conclusion about whether or not this was a good product is the issue of them realizing that all these fees don't actually reduce the principal, and that this is the only form of, when you compare payday lending to traditional consumer credit, it's the only form of credit that doesn't allow partial payments, right? And so you think to yourself, there's something morally wrong when any other thing that you get, your credit cards. You're not expected to pay your car loan off in one payment. You're not expected to pay your mortgage off in one payment. And that your research really needs to address the issue of the inability for these fees to count towards reducing the principal.
Okay, so I guess you disagree with me that payday loans are simple and that people understand them. I guess I can't take a moral stand on,
Yeah, but can you research it empirically?
Yeah, I can. I have data to. I guess you want to know what percent, how much money people are paying in their rollovers. I'm not sure what you're asking for exactly, but I would.
That's part of the question, but actually getting at the issue of people who do wind up making all these rollovers, and they're dismayed about learning that they never get anywhere. They're on a treadmill of debt because the rollover fees don't count towards reducing the principal. Unlike other forms of traditional credit where you make payments and payments reduce principal.
Yeah, so I guess this gets back to Hilary's kind of call for more research on whether constraining rollovers are good or bad. I haven't done research on that, so it's certainly something I can look at. And I hadn't really thought about it in exactly the way that you're setting it, which I like. Certain things about payday loans are very different than other kinds of credit, and payday loans have this aspect that I hadn't really thought about that more recently, but thanks.
John?
My question is for Chris. Chris, several speakers have pointed out that overdraft protection programs can be functionally equivalent to payday lending. Would you extend your side proposal to credit unions and banks?
Well, so the model ordinance that I've drafted, that's an appendix, that's included as an appendix to my article, hinges or triggers the ordinance on the finance charge, or APR. And my understanding is that currently the banks still don't have to disclose an APR, which would mean that it doesn't apply, as it's written, it doesn't apply to banks now. And that's one of the things that I'm a little bit uncertain about that in my own mind, and have been debating as I write the proposal. I think I'm not entirely convinced that bank overdrafts have as many onerous contingent or longer-term side effects. I don't hear much about financial institutions or depository financial institutions suing borrowers to recover, significantly growing or expanding interest. Surely the price is higher if it's a small check that they bounce, but they're not. Most financial institutions, as I understand, aren't charging an additional 500% on top of that, which is, I think, not all payday lenders are doing that, but certainly some in the marketplace are. I also don't see the attorney's fees, a whole host of other contingent fees that seem to come along with the payday lending industry that just don't seem to be there. So, but I'm cautious about that because I'm no friend to bank overdraft fees. I'm sure you would all anticipate that. Would we put that on there? I'd be okay with it. I think it'd be harder to get it passed through a city council. But if it was there, it would probably put some real pressure on financial institutions to lower their overdraft fees, which I think is actually helpful. And unlike, for example, Professor Zawicki yesterday, I'm not super comfortable with cross-subsidizing financial services on the backs of people that are having challenges in their life, balancing their checkbook, that sort of thing. So I tend to think it would be just fine with me to have it on the backs of banks. But another concern I have about that is I think it would be hard for local governments to distinguish whether or not it should apply without some federal regulatory hook, which is why I put it on APR. The local governments are not going to have the sort of sophisticated apparatus to tell which loans are and are not going to fit into the scope of the ordinance. So what that would do is it would punt that question that you're asking to the Consumer Financial Protection Board or to the Federal Reserve, whoever gets jurisdiction over that question in the long term. So I would punt. What's that? George Washington, John? Washington University.
Okay. Payday loans don't affect your credit report, so I think that's an important distinction to make.
Rob.
I have a question for Mr. Webster. It's going to be inside Hilary's church. I liked your paper, and I thought the section on price and profit was pretty convincing. But the section on debt trap, I'm not fully satisfied yet, so I wanted to push you just a little bit with a fact. And I just want to see how you respond. And that comes from Florida. which, if you're going to pay the loans, I think the regulatory model is pretty good. So it's a responsible state. They were out in front from the start. But fiscal year 2009, 120,000 residents of Florida borrowed payday loans 16 times or more during the year, and they accounted for a third of transactions payday loans in the state. And 20,000 people in Florida borrowed every legal day of the year. And so what one wants to know is that responsible lending, and do you think that scale of borrowing can be welfare enhancing for consumers?
Say what? 20% borrowed 365 days a year?
20,000 people in Florida borrowed every legal day in the year. There's a cooling off period. So you can't cooling off.
Well, let me say a couple things. First, our business model is predicated on people using our product when they need it. Every time a customer has a choice, if they need credit, between what we do and what the alternatives are, we want them to use our product. I have absolutely no problem with a customer using our product a bunch of times if they're doing it for the right reason. So we're in a customer service business before we're in a financial services business. I'm like the cleaners. I was in the fast food business for 12 years. I'm like Bojangles. When I want a sausage biscuit, I want people to go to Bojangles. I don't want them to go to Hardee's or McDonald's. So, it's at sort of the 50,000 foot level. Repeat business doesn't bother. So then you move to, all right, how is the government, the state, going to intervene and make a judgment on what repeat business is qualified? And Florida is actually a very good example because there you have an intervening cooling off period. You must tell the customer that they have an opportunity to enter into an extended payment program, which is sanctioned by a credit counseling agency. And then we have our own extended repayment plan. Any customer at any time, for any reason, can access a unilateral right of modification. We can take their pay period, if it's not, instead of a loan being due in 2 weeks, it becomes due over 5 pay periods. So 2.5 months. So what I would say to you is that public policy ought to build in some mechanisms for customers to have to reflect about why is what they're doing reasonable. It's what they're doing rational. It's what they're doing better than the other alternatives that exist in the marketplace. If they make that judgment, I'm opposed to telling them it's a good idea to say no. After 5 is too many, 7 is too many, 1 is too many. I don't think that's appropriate public policy. I do think Florida is. So, to answer your question, if somebody gets a payday advance, average duration for Florida is about 18 days. They have to leave, they have to reflect. If they want to come back, that suits me fine.
We have 3 minutes left.
I just have a question about that, about the repayment plan. So how do customers find out about this, and do they find out about this?
They do. We give them, when they come in, we disclose it to them at reasonable intervals after that. James, we have a brochure that we give them after every 3 transactions, 4 or 5, that discloses, it says, look, you are beginning to use a short-term financial tool for long-term financial purposes. You need to reflect on whether this is right for you. You have an extended payment plan, and there are other alternatives that other people offer, not us. So and then in states where it is part of the law, we're obligated to disclose it every time.
And when you're telling, I'm sorry, and I hope I'm not too aggressive here, but when they tell them all of this information, do they also then say, and if you do this extended payment plan, you can't get another loan? Is there a little other information provided about lack of access to additional capital?
Probably. It depends on exactly the terms of the state regulation. With our extended repayment plan, we disclosed that they can't get another payday advance for 6 months. But that's what we should do, right? If somebody has to go into an extended repayment plan because they can't pay back, you want them to leave the credit world for some period of time and get sort of fixed whatever's broken. So, I don't know whether you were saying that's a bad thing or a good thing, but we view it as a good thing that they can't have that.
I just think some customers, from what I've seen, see it as kind of you're being told not to take the payment plan. for reasons X, Y, and Z, and to take out a new loan instead.
Last question.
As somebody who has tried to take out payday loans, in research and with borrowers, I guess it's when you go into the store, it's not the same as sort of what happens what is supposed to happen. So do you ever go into stores and see the difference, going undercover or whatever, and see the difference between what is supposed to happen in the store and what are the actualities? When I go into the store and I ask even just a simple question about, exactly how much is this going to cost me? I'm just asking the way I would ask if I was going into anything.
It's a very good question, and I think we're a public company. So we have a heightened obligation to make sure that what we say is what we do. We're regulated in the states where we are in business. We're regulated by a state banking entity, right, who does a number of audits on our branches every year. We have a very robust internal audit function, which we're required to have through Bramlage-Bliley and Sarbanes-Oxley and other federal legislation, where we have to report to our audit committee and our board, which is then reported to the shareholders about what the results of our internal audit represent. So we do all that, but I'm here to tell you, every consumer business I've ever been in, we screw up. It is impossible to get it right all the time, and when we do mess it up, we have an obligation to fix it, whether that means refunding a loan to the customer or apologizing, or in some cases being sanctioned by the state. We do 15 million transactions a year, and out of those 15 million transactions, we receive about 100 complaints to state regulators nationally. So we're not perfect, but we do the best job.
I guess I've been to Advance America stores in particular about 6 or 7 times now. And I think almost every time, and I've been to Cash to You, Payday today, and I go to pretty much all of them. And I have to say, it's hard to get actual disclosure. You get the pamphlet, but it's never sent to you. You're in Virginia, you're not required to say anything to the borrower. You're just required to give them the pamphlet. But I guess in my experience, it hasn't been quite as open and or forthright, even when the borrower asks questions.
So we're going to have to stop now, but I will just tell you that as a compliance guy for this industry, many lenders discourage their employees from making oral disclosures to consumers and ask the employees to rely exclusively on the written disclosures simply in order to avoid any possibility of misunderstanding of those disclosures. So if you're having trouble getting information, you should ask to have it in writing. Chances are you will get it.
Oh, sure. The other thing that I found, though, is if I went in as a borrower and just said, hey, I'd like to take the contract, the application, so I can read over it maybe at home and figure out if this is what I want to do, you're not allowed. I've never been into a payday loan store that allows you to take an application to read it over ahead of time. And if you're filling out the application, or what's been my experience, filling out an application in the store, is they pretty much try and rush you. They're like, why is this taking so long? You gotta hurry up. And if you can't fill this out right now, you can come back, but you can't take it with you. We have to keep.
I'm sure that probably happens, but you can get ours online.
Yeah.
I don't dispute at all what you're saying. I think that's terrible, but I'm sure it happens.
All right, thank you. We're now going to break for lunch. We'll have everyone be back here at 1:20. If you be on the 4th floor in the faculty lounge, if you need help getting there, sign the red pass.
Yeah.